How's it going, everybody? Welcome back to a new edition of Smart Money, Smarter Moves with your host, Sameer Sawaqed, Director of Client Engagement at Freedom Family Office, and our reoccurring guest, our Chief Investment Officer, Kyle Cain of Freedom Family Office. We know it's been a little over a month and a half since we last spoke to you. And since we last spoke to you, there's been a lot that's happened in the markets and in general with different announcements like a new Fed chair. So I know there's a lot of updates. You might be overwhelmed as a listener. You might be thinking now, hey, it's the new year. What am I going to do for my investments? What's the outlook on the markets? Just a reminder, Smart Money, Smarter Moves is our official Freedom Family Office podcast that brings you education and guidance through a short 10-minute episode or so with our CIO. We try to come on every few weeks here and help teach you a little bit more about what we do at Freedom Family Office so you can hear from our CIO directly, because when he's not on this podcast, he's busy working on client portfolios. So, Kyle, maybe give us an update. It's been over a month now since we last spoke to you. There's been a few different things that have happened. It's been a crazy time in real assets. It's been a unique change with our new Fed chair that President Trump elected. But just start over. What are you seeing high level? What are your thoughts on the market?
Yeah, so like you said, definitely been never a dull moment around here. I think the so far, right, what we've seen this year is we've had a couple CPI reports. We had the government shutdown at the end of last year, so we had some missing pieces of data. And now we have earnings season coming out. We got a new Fed chair nomination that still has to be approved, but should likely get approved here. So ultimately, I'll say a few things, right? So far, markets are still up year to date. We're into January, at the end of January, beginning of February here. Markets are up, but it's been a little bit of this rotation, right? I mean, I think a lot of our listeners will probably understand that, right? The big tech, the AI, there's been a little bit of a rotation where there's a concern on the spending, on the overall spending. Is there going to be return on investment? So again, I'll give you my upfront. I don't think we're necessarily done there. We're going to still continue to see huge earnings out of tech so far. Q4 earnings season. I mean, it's like a projected 30% earnings growth for technology in Q4. So I don't think we're done there, but yes, it is a little bit of a show me. Show me if there's actually some return on investment. So we saw Meta do well because their earnings, even though they're spending like crazy, their earnings were actually great and they had some good guidance going to 2026. Whereas Microsoft, for instance, got hurt a little bit because their cloud revenue still grew, but not as much as expected. It was like 27% growth versus 30 something expected. And they're spending like crazy. So I think what that ultimately means, though, spending still there in the AI trade, and certainly going to help the different stack levels of AI companies and infrastructure companies, that it makes sense to continue to expect good returns there going forward. But my point here is that the rotation was started moving into small caps, moving into more cyclical companies. Here, like we saw small caps, it's like, I don't know exact the official January was, but it was around 9%, or 6%. We had a down day on Friday, so it was around 6% for small caps. Emerging markets did well. So we've had a little bit of a rotation. The dollar has continued to depreciate here a little bit in the beginning of the year. And the Fed had its meeting last week deciding to hold rates. So what the rest of this year, well, I guess we'll talk about the new Fed chair first, then I'll talk about what I think kind of next year. So we finally have the new Fed chair. Immediately, what happened on Fridays, we saw a the bond market didn't move too much, but it steepened a little bit, meaning the short ends came down a little bit and the long end moved up a little bit. But gold and silver tanked, and the dollar rose. Reason
And Kyle,
being,
do you think gold and silver, are they related to Kevin Walsh? Or was it also?
it's related. It's related. I would say the main move there is it was just way overbought. And I mean, it's completely overbought, and it needed some sort of catalyst to have a sell-off. But Kevin Warsh had that impact because historically he's been pretty hawkish, vocally coming out hawkish about expanding the Fed's balance sheet, and and saying that that's against quantitative easing. So that would be, if they rein that in, that would be dollar positive and potentially have higher, longer term yields, which is not what gold wants or silver wants, right? They want a weaker dollar. However, more recently, he's been more dovish, been more in favor of what the administration is. So I think it was a little bit overdone. It was just a catalyst that needed to happen because it was so ridiculously overbought. I mean, the overall thesis for commodities was, especially gold and silver, a little bit different, but gold was central bank buying. But actually, last year, central banks were down a little bit from 2024, and their gold buying was still higher than it's been for a long time, but it was down a little bit. It was mainly retail investors, ETF flows, that really had kind of pushed up this parabolic rise that we saw in the commodities. So I think it's just an unwind. Usually, when you see unwind in gold and silver, it lasts 1 to 2 months. So I don't know if it's a right away buy the dip here, but I'm still bullish on gold. Silver is a harder metal to kind of work out because there's both industrial slush, precious metals composition. So yeah, it did have to play with Warsh. But I think what we should expect going forward is, you know, Goldman Sachs thinks there's going to be 2 rate cuts this year. JP Morgan thinks there's going to be 0 rate cuts this year. Um, I'm leaning towards maybe somewhere in the middle, right? I think we're going to see inflation pick up. A PPI report came out, which showed inflation tick up a little bit, which leads CPI by a few months. So we should probably see CPI come up. But my gut is that we're in a good economy, right? I think between the one big beautiful bill, the continued spending on AI, um, let's talk about the one big beautiful bill is going to help consumers a lot, right? They're going to have big refunds back in their pocket to help maintain their spending. If you look at the cash that they're sitting on, still, all-time highs, even though the saving rate has dropped a little bit. The way the saving rate's calculated doesn't calculate some of their other cash in there. So the consumer is going to be in a better spot, in my opinion, even though inflation is there. And then let's talk about businesses. We already know that the big companies are spending like crazy, the hyperscalers on AI, but the rest of the market hasn't, mainly because of policy uncertainty last year from tariffs. Well, now I think again we're coming into a midterm election year, probably going to see more focus on affordability, less tariff rhetoric, and businesses realize they can't hold off forever, and now they have these, immediate expensing and R&D benefits for in the one big beautiful bill that helps their bottom line significantly to be able to continue to increase their capex, which should help employment, in my opinion. So if you're in an environment where employment's probably going to stabilize and and inflation might go up a little bit. I don't see the Fed cutting too many times this year, even with the new Fed governor that the Trump wants in there. So maybe we get one or two. I don't think he's going to be that hawkish. He's going to be more dovish. We're not going to worry about quantitative tightening for a while. But that means that interest rates don't move that much. So you probably get your carry on bonds, but I'm still constructive on equities. So I know
Yeah.
there was a lot that I went over, but um, yeah, it's still bullish on gold. There just needed to be a sell off. Let it kind of settle down. If you missed the ride, you feel free to diversify a little bit into it, but don't. Even though tech hasn't done very well in the past couple of months, still tech's going to do well. Industrials are another sector I really like. Communication services should do pretty well. Um, yeah.
No, that was a lot there, but good. It was good context, and we haven't spoken to you in a while, so we're always itching to pick your brain. But I want to ask you about gold. You say you're bullish on gold. I'm looking, and I wish I could share the screen. Maybe going forward, we could do something like that. But pre-run to 2023 on average, for the last 10 to 12 years, gold was returning between 5 to 5.8%. And now when you add the recent returns, it's between 11 to 14%. Historically, though, it says gold, the S&P returned annually from '09 to 2023, 13.8, whereas gold was 6%. But gold has had a crazy run this year. When you say you're bullish on gold, are you bullish on the fact that you can get similar returns to an S&P, or just what historically gold has been used for, which is just to protect yourself from inflation? What do you mean when you say you're bullish on gold?
Yeah, so I'll say I still always should use it, even if you're bullish on it. Don't have it replace your equities, right? I mean, it's still a there's no interest, there's no cash flow, there's no anything. It's just again same thing of what someone else is willing to pay for it. So have a really majority of your money should still be investing in companies that are going to continue to compound earnings and it's real wealth creation there. I'm bullish on it on the dynamics that it still is a limited resource, right? There's only so much. I don't have the exact numbers here in front of me, but it's like, they can only increase supply 1-2% a year. I would say we could find a huge gold deposit somewhere that is easy to access, but chances are we can only increase supply so much. And in the environment that we're in with the geopolitical issues, we know geopolitics doesn't necessarily impact earnings in the stock market much, but it can have inference on, again, what central banks decide to buy. Are they going to buy up on gold? Are they going to buy in US dollar? Are they going to switch to another, BRIC country currencies? I wouldn't be concerned about that. But if you're thinking of, I don't want to go that risky, but the dollar could devalue further, which I would say most economists think is likely going to happen, is that there's still some more depreciation there. Gold becomes another great hedge, another great alternative. And so I saw a recent research article that showed a certain supply and demand curve over like a 10-year period, and it was showing easily gold getting up to 8,500, 9,000, 9,000 with this demand curve. So that's again just become back to supply and demand of the
Right.
particular commodity. So yeah, I wouldn't. My point is, I'm bullish long term. Still could be more downside here. I think we're at 48, 47 or something today. Um, but never as a replacement. Still mainly just as a hedge. A few percentage points, right? 0 to 5%, ish or so is kind of a good mark on how much you should have in that. Same thought as like Bitcoin. Bitcoin's now into the 70 some odd thousand. Still a long-term bull on it, but that has even more question marks. So it deserves to have more volatility, right? Like, can quantum computing basically crack, and get into anyone's wallet and and completely make Bitcoin obsolete? That chances are by the time quantum computers can do that, there'll be fixes, but you never know. So it's again, just have a little bit of a diversification and these
Right.
other asset classes, but stick with companies that actually produce real things and have real earnings. And yeah,
Right. Now, when you think of how to actually invest in gold, I know you might do that on behalf of clients. This isn't investment advice, but for those who don't know, are you talking about buying like physical gold from Costco or jewelry, or are you talking about buying an ETF like GLD?
the easiest way to obviously have liquidity and get in and out and stuff you want is the ETFs, right? So that's usually what I recommend. Obviously, you can have what I think like, I haven't personally bought it from Costco, but I hear they'll give you a little bit of a spot discount or, or something when you're buying certain metrics. So it can be good to have it in in your safe or something. But ultimately, most investors, right, like if you just want what should be the real, you're never going to actually go to a store and buy with gold. If anything happened in that type of environment, we've got other issues. So you might as well just do it with ETFs, pay a little bit of an expense ratio. The expense ratios you're paying on a gold ETF is a lot cheaper than it would be when you actually want to cash in the markups you get from dealers trying to deal with the commodity yourself. So yeah, I
Right.
mean, I don't say there's right or wrong. If you're a long-term holder and you want it, great. But I like the ability to get in and out quickly in any type of asset class. So I stick more with the ETFs.
Are you surprised at all by the gold's run?
Yeah. Yeah. I mean, like I said, there's always a supply demand like formula where you can try to say, all right, if central banks ramp up spending, and I was surprised on how much China and some of these other countries, and we don't always fully know how much China is buying, but I was surprised um, how much they're buying. But then, all right, I can start to quantify what is the intrinsic value of gold if it ramps up a certain amount. Then you get the other elements of retail investors trying to the fear of missing out, right? And that is always hard to gauge. So you can build that in a little bit into your price models. Like, all right, if an asset class is going up and there's so many geopolitical headlines, gold might be a place. But if you look back, which I've done historically through the past 20 years of, investing in the markets, gold will have a certain premium that gets priced into it during these runs, but not quite as much as we've seen over the past year or so. So yes, I was, a little bit surprised. I had exposure in all our clients' accounts, but not right. Had I known it was going to be this much, I would have had more. So yeah.
Exactly. And I heard you say something that you don't really know too much or aren't super excited about silver, but silver deserves some talk with the run it's had too. What are your thoughts there?
Well, silver, I mean, it just went, in my opinion, way too much beyond um, the supply demand right dynamics on it. It was just completely overbought. But the markets can stay irrational for a lot longer than people can remain solvent is one of those quotes that go out there. So shorting it isn't a thing. It's too expensive, I'm going to short silver. No, I'm going to let it ride for the most part. I did actually sell some off before the big sell off in some areas that got a little too, again, parabolic with its price. But my point though there is there's two aspects to it. There's the actual debasement trade, the store of value, which is hard to always again quantify because central banks aren't stocking up on silver like they are on gold, but it's still a physical commodity that has value, and the value should be derived of how much it needs to be for EVs and for data centers and a lot of so that's a lot of what this was like. Hey, we know there's going to be tons of ramp up over the years for certain metals and materials, and because it's the next closest, I think, of gold in the thought process of safety, that it got a lot of the flows coming into it, if that makes sense. So but again, there's still the demand for silver is great over the next 5 to 10 years, but not at the price it was trading
Right.
at. Yeah.
Right. Kyle, thank you so much for coming on, and we'll see you guys soon.
Thank you.